All right, folks. Well, welcome to the Q4 market commentary and economic update. The goal today is to chat for roughly 45 minutes or so, maybe a little bit longer, and then open it up to answer any questions at the end. So a couple things before I jump into it. If individuals have any questions or comments, they can actually just put it in the Q&A box. If you're on a computer, it's usually found at the bottom. If you're on an iPad, I think you just hover the screen and you'll see it. So I guess before I jump into it, so first off, thank you very much for joining us today on this rainy Wednesday afternoon. Fall, as I look out the window to my right, is definitely upon us. And it's hard to believe, but we're 10 weeks from the end of the year. So like I said, the majority of the year is in the books, and man, has it been a one to remember for sure. So today what we're going to talk about is, as we get going here, is there we go, is a couple of things. One, market and economic comments. We'll spend some time on it. I'll spend the first probably third of the chat today discussing this. It's very timely. I mean, a lot of stuff is going on in the world today. Bank of Canada is set to announce their policy decisions. So a lot of interesting information that's going to affect the economy and lending rates is just around the corner. I want to talk a little bit about pension style and traditional strategies. So talk a little bit about what a lot of folks on this call, what we've been doing on their behalf, the benefits. And then for those of you that join me for our special session on estate planning, the great wealth transfer, I'm just going to spend 4 or 5 slides. It was extremely well received. We've had a lot of folks that have followed up with us afterwards. A lot of my meetings that have had post session, we spend a good chunk of it on these topics. So I just wanted to touch base for those that didn't get a chance to join us. And then the last one, I have 6 year-end tax planning tips. So again, some of these that we're doing on your behalf, but other ones that you might want to be considering, as I mentioned, as we head into the home stretch of the year. So again, for those of you that have joined me before, I always start off with a little bit of a cartoon to get off on the right foot. And I don't know about you folks, but I'm a little tired of talking about inflation, but it's something that's been persistent and has been sticky for the last almost 2 years. So for those of you that are following the Bank of Canada, the CPI number for Canada just came out yesterday. It actually came down, which was nice. This one, again, I did this PowerPoint before yesterday's announcement. So we actually had back-to-back months of increases in CPI of inflation rate prior to the most recent announcement. It's been really sticky. A lot of the goods that we buy at grocery stores, when you look on a year-over-year basis, they're up, anywhere between 5 to 10%. You go grocery shopping and you'll actually find that. You go to a restaurant. Again, we're starting to see it more and more. And I think for a lot of Canadians, this whole inflation and cost of goods is getting a little long in the tooth. At least that's how I feel. Given the fact that inflation has ticked up here in the last couple of months, notwithstanding just most recently, the Bank of Canada, there's a good chance that they actually might increase the next round of interest rates, as it's definitely on the horizon. Now, one of the other things besides just cost of goods and inflation rates, when we're looking at what the Bank of Canada will do is also the U.S. jobless claims. So, unemployment benefits, and if you look at labor markets, they still are resilient. They're still very strong. Partly, the reason is because, especially in Canada, we have a lot of immigration that's happening. So we've seen a lot of population growth, which means they're coming in and they're actually picking up jobs that would otherwise go to folks that were here before we've had this big immigration push or a big immigration flow into the country. So when we're looking at it, we're still seeing historically low unemployment numbers. But if we actually look at it, I've highlighted it with the this yellow circle, we can actually see the unemployment numbers have actually ticked up a little bit in recent months. And the reason I actually show this, if we get cooling inflation, which we got yesterday for 1 month, and we get some of these unemployment numbers going the opposite direction, these are reasons why the Bank of Canada or even central banks around the world, including the US, may not hike. Okay, but I have a hunch that we might still see another rate hike, a small one. It wouldn't surprise me by any means. just again with the data, they're still trying to get ahead of these numbers and try and get it down towards that target of between 2.5% to 3%. Okay, so as long as we have continual sticky job numbers and sticky inflation, rate increases will continue to be on the table for central banks around the world. And so the next thing, when we look at from an economic point of view, we look at, is there going to be a recession? And we've been talking about this for quite some time. In these sessions that we talk about, I've been chatting now for almost 2 years. I've said, I'd be surprised if Canada skirts a recession given everything that's been happening. And when we look at it from an economic point of view out of the US, or from, the feeling from economists, a recent survey within the last 2 months, they think, most of them think there's going to be a recession. 2/3 of them think there's going to be a recession. And 16% thinks there's going to be a soft landing. So it's definitely something that's still on the horizon. It's likely going to be pushed out, obviously, to next year. We do have GDP, which is one of the key indicators of whether we're in a recession. Those numbers are still coming out, some getting revised downwards. But again, it's just a general slowing of the economy. And we have seen that been occurring over the last couple of quarters. So, if they do announce a recession, again, we want to be mindful. A recession doesn't mean we're screeching to a halt in that moment. Rather, they're going backwards and they're saying, hey, a recession started however many months prior. So when they announce it, keep in mind that we will be in the midst of a recession when they've actually determined that there will be a recession. Okay, it's a little counterintuitive because what happens often is markets tend to improve when these types of announcements come out. We might get a knee-jerk reaction, or we might get a little bit of volatility, but over the long run, the economy starts to improve while we're in the midst of a recession. Okay, and a good example of just this kind of economic volatility or uncertainty, I had an individual that reached out to me by email, and they said, the U.S. can't settle on a speaker. We have rising inflation, hot labor markets. We have another, a global situation, obviously overseas, and yet the markets are going up in the last week and a half. And that's because of a number of other issues, which is, hey, CPI is coming down, earnings are a little bit better. So it can be sometimes a little bit difficult. The only thing predictable is that it's unpredictable. Okay. And then when we look to, from a point of view from folks like you and I, here's something when you actually look at just the talk or the chatter of recessions. I came across the slide. I was really interested in it because it says, number of articles mentioning the term recession. Okay, and we can see this significant spike here in the most recent months. So there's definitely the feeling. I think a lot of folks, a lot of Canadians, a lot of Americans are actually feeling, are we on the cusp of a recession? And like I said, it wouldn't surprise me one bit. But again, I think if you have the right mix and you're doing the right things, we'll work through a recession just like we have in previous years. And then this last piece that I'm going to wrap on this part of from an economic point of view. But when you look at it from a banking point of view, from a banking, a lending point of view, when a bank start to tighten their lending standards, it's another indicator of, potentially going into a recession. It's a good economic data that tells us that we could be on a cusp. And we've been seeing this. I know there's a lot of folks on this call that may have had to go and get a mortgage or some sort of lending product within the last 12 months. And you've likely felt it yourself where the banks are a lot more strict. And before, you could have a situation where you have a really high net worth individual or someone who has good assets and maybe low income. Okay, so as an example, Canadian retirees, my mother-in-law was in this situation. She had good assets, but she lived on a smaller pension. And when they go in to get a funding, maybe they're downsizing, maybe they bridge financing, the banks just simply aren't lending because, when they look at a debt service ratio, they recognize they have the assets, but they don't have the income to justify that monthly payment. So we are seeing this. Like I said, banks are lending, a little bit less freely than what they were. We saw it in 2008. We saw it in 2009. And this, again, is one of the reasons why we've been discussing with our families that if they don't have a line of credit against their property, if they have good equity in there, we always suggest that they explore that opportunity. Because based on, if you don't need it, it's usually a lot easier to get it. Or if the banks are freely lending, they're more open to actually putting one on that house or what have you. And then it gives you that flexibility because, again, your house a lot of times is one of your biggest assets. And so by having a mortgage against it available, it gives you that opportunity if for whatever reason you need to bridge, again, a property purchase or what have you, you have the ability to access, some lending on a short-term basis. For those of you that haven't done it, perhaps it's a conversation that we need to have, but with interest rates the way they are and banks tightening, it might be a little bit more difficult to get it today. So again, it's something that we're going to have to plan for as we work through this period of time. All right, so we're going to switch gears. We're going to talk about market comments right now, because again, if you look at what's transpired over the last 6 weeks or so, we've actually had, a dip, and then we've actually had, good days, and we recovered a lot of what's happened in September. So when we look at September as a month, September has historically been the worst month for stocks. And so when you look at this chart on the left-hand side of your screen, okay, it's a 30-year period ending 2022. We can actually see September is the worst month on record. Okay, that's a 30 year or 30 periods of September that shows that it was the worst month out of all months. And when you look at a short-term period over a 5-year period, you can actually see same thing in September, worst period for markets over the last 5 years. It's the worst month of the 12. Okay. Well, listen, guys, September did not disappoint. It lived up to its billing. September was a month where we had obviously CPI numbers that came up. There was a lot of talk about whether the Bank of Canada would continue to tighten, or even the central banks would continue to tighten. Plus, we had some other economic information that came out, and the best performing, investment or asset class that month was bonds, and they were down 2.6%. And I'm going to talk a little bit about this, how traditional fixed income has actually really let Canadians down over the last 3 years. And fortunate for a lot of our folks, they don't own a lot of fixed income, traditional fixed income, because we recognize in a rising rate environment, fixed income really is sluggish. Okay. Worst performing market in September was the NASDAQ. Now, the NASDAQ has been the hottest for the year, but we can see that for the month, it was down 6%, roughly 6% as a market. So by far and away was the worst performing market of the bunch. Okay. And I'm going to talk a little bit about the S&P 500 and the NASDAQ. We're going to unpack that a little bit. So, hang tight. We'll provide a few more comments. Now, with the volatility that we saw in September, this fear and greed index, which I've talked about before, I've shown it in a little bit different graphic. But when we actually look at the fear and greed index, there's about 7 to 10 different indicators that goes into this timeline. If we look over the last 12 months, we've had periods of extreme fear. So last September, October, okay, we had it again in just before March, April. And then we're seeing it again here in September. We can see that it bottomed here in October again, and we're actually going on the opposite way. So with this volatility, the overall feeling of investors, fears is kind of what's crept in people's minds again. And we need to be aware of that, because again, things can shift quite quickly. And, if we look at extreme fear here a year ago, 3 months later, we've had periods of extreme greed as well. So, through those summer months. And this goes back, a lot of times you hear people say, sell in May and go away. But this summer, the sentiment, the investor sentiment was one of the highest it's been throughout the full 12 months. So again, just a reminder, this goes back over the last 30 plus years. This is a chart. Hopefully you can see it okay. But this is, gives investors, why would they sell? Okay, reasons to sell in the market. And again, if we look at from an emotional point of view, I talk about this a lot. When we get nervous about the markets, we get nervous about the volatility. People tend to sell at inopportune times. Okay, so these are all the major events that have happened over the 30 plus years. There's recessions. There's financial crisis. This is 2008 and 2009. Okay, here's one in 2011 where the S&P was downgraded. From AAA to AA plus. And that's a big one. And it's relevant because they're talking about it. Again, this is what happened a few weeks ago, where they've talked about downgrading the US credit. Okay. Back in 2015, we a lot of times forget, but Fed raises rates for the first time in nearly a decade. So we went through a period of rate hikes, 8 years ago, and they hiked for a little bit and then they stopped. And then again, COVID, very event driven. Okay, very short, but again, great reason to sell. And then here's what we went through last year. It was the first bear market that we'd seen in close to 12 years. Okay. And despite all of these various declines that we've had over history in the last 30 years, the markets have actually gone up over time. And I believe if you own good quality companies, that too will be the same. So we just really got to focus on not the short-term noise, but the mid to long-term time frame. And when I say long-term, and I've said this before, I don't mean 20 years, 30 years. I'm generally talking about a cycle, okay? A 6 to 8 to 10 year cycle of a market. Well, we're just coming out of a bear market, and the economy and the markets are struggling to get some footing to kind of get into the next stage of that bull market, which we have, technically it's defined as a 20% increase or more. So we have hit that on some of the markets. But my point is that, as we work out of here, we're going to go through another cycle of likely 6 to 8 to 10 years of good growth as we work through this part of the economy, as inflation comes, more under control, interest rates, as they start to fall, once the central banks start to add money or change their monetary policy, so more money is flowing into the economy, we're going to see sustained growth once again, just like we have in all these other periods after we've seen a contraction. So let's actually look at it from a market point of view. So we've actually had fairly good markets this year. Okay. Now this chart actually shows the markets over the last 22 months, which goes back to January 1 of 2022 to today. So last year, as you know, markets were down anywhere between 9 to 10 to 30%, depending on what market it was. Okay. Well, if we fast forward 10 months, we have actually seen growth, or we have seen upwards trend, but it's just making back a lot of what was given away last year. So when we look at it, and this was as of the 16th, so 2 days ago, if we actually look, the 2-year return on the markets, we're still down. This one here was the Dow Jones, was the best performing market, down 6.5%. Worst performing market, which is a real surprise, but is the more conservative bond index, down 17.5%. Okay, now what's really interesting is most Canadians own 40 to 60% in this asset class. So unfortunately, we recognize that equity markets, they will go up and down over a cycle of, as I mentioned, 8 to 10 years. Okay, and generally when you're riskier, and when I say risky, I don't mean it's out of line, but when I say riskier, it just means equities will fluctuate more. Okay, so when those tend to contract, most investors tend to go to more conservative investments, which would be fixed income. Well, in this case, we had fixed income over the last 20 months has actually fell at a faster pace than equities, okay, which is highly unusual. So for those individuals that are in a more traditional investment profile, again, a lot of Canadian retirees, not only are their equities been sluggish, they're actually more conservative investments have dragged them down pretty significantly as well, okay? So let's change gears a little bit and talk about the markets. Let's unpack the markets a little bit more, so a little bit more micro. So when we look at the returns this year, the S&P 500 and NASDAQ has been the two best performers for the year. Okay, they've had double-digit returns, but it's been a very narrow market. And what I mean by that, it's not, if you look at the S&P 500, it's not the full S&P 500 that's done well. It's been about 7 companies, okay, which has driven the gains on the S&P 500. So what this chart shows here, it actually just shows the top 10 holdings of the S&P 500 over a period of time, over every decade, 1980, 1990, 2000, 2010, 2020, and here we are today. So when we go back and we look back 40 years, you recognize all these big companies, IBM, AT&T, Exxon. While, we've been going through, innovation over the last 40 odd years. I'm going to show a slide on this in a second. And so what's happened is there's just been a natural evolution of the top 10 holdings within the S&P 500. But what's interesting, if you actually look in the earlier years, the largest position before 2020 was 3% Exxon, 4% General Electric. Okay, and everything else were smaller, 1.5% to 2%. And when you see on the bottom of the top 10 holdings, we're roughly 20 to 25%. Well, fast forward to 2023, and the weighting of the top 7 holdings account for almost 28% of the market. So here now we are in 2023. It's largely tilted towards technology, and it's largely tilted towards 7 companies. Okay, so what that means is when those 7 companies do well, the overall market does well. When those 7 companies pull back, overall the rest of the market goes down. Okay, now if you were to look at the NASDAQ, it's even worse. if we look at the top 7 companies just on the NASDAQ, those 7 companies I showed you on the S&P 500 that represent 28%, they represent over 50% of the NASDAQ. So it makes sense why the NASDAQ is done well. And by association, the S&P 500 is done well simply because of these 7 companies. Okay. Now, this is what I mentioned before about these innovation cycles. And when you go back to the top 10 holdings, 80, 90, 2000, and so on, you can see a lot of these waves that we had, even 40 years, electronics, aviation, petrochemicals. Prior to that, it's electricity, internal combustion engines, so on and so forth. Well, where we're at in the last, couple decades and moving forward, it's much more tech driven. So it actually makes sense that the markets have evolved to have a greater weighting to technology stocks, but unfortunately, right now they're just very concentrated. So the only way to actually get similar results is for us to buy those 7 companies and overweight them. The problem is those 7 companies were down 20 to 30%, 40% last year. So we've learned that our clients, our families, they're not comfortable with seeing 20, 30% declines. So what you do is you diversify them, you average them out, and you still participate in them, but you don't participate in the same concentrated risk as what we're seeing in the markets. So where we're at right now, kind of this 6th wave, it's this AI, robots, clean tech. And so when we look at it and we're getting conversations or comments about it, we have a lot about Chat GPT, OpenAI, AI, and so on. So a lot of these companies, unfortunately, are actually private companies. So we can't invest in them directly until they do an IPO, but we can invest in them indirectly through companies like Apple, Microsoft, NVIDIA, and so on. So again, a lot of our folks will own some of those companies indirectly or directly, but again, on a smaller scale than what the actual markets are. And then the last 3 slides on the market. So again, this is an example of the equal weighted return on the S&P 500. So year to date, it's up around 14%. It's given away a little bit today, so it's probably closer to maybe 13 to 13.5. But if you actually go equal weight, look at this. If you equal weight all of the companies, the S&P 500 has only returned 0.82% this year. Okay. So again, those 7 companies are responsible for roughly 75 to 80% of the overall, if not more, of the overall return. The other 493 companies represent only a couple percent. So we have to really unpack it when we're looking at just, the media gets everybody, including me. They get them every night for an hour or 2 hours to talk about what's going on in the economy, what's going on in the world. We get an opportunity a handful of times a year, maybe a month or whatever, to actually talk about to unpack these and talk about, what's really happening, not based on what the media is saying, but what's truly happening like this. Okay. And the last kind of 2 pieces is again, I think it's important. I've said this before, why do we invest, folks? Okay. We don't invest because we're excited about the volatility. Okay. Maybe some people on this call do, but most often we invest because we need to outpace tax and inflation over the long run. And we need to have our money grow so that as inflation creeps up, we can continue to buy our goods and services. Best way to look at milk, look at gas. These are a lot more expensive than what they were 20, 30 years ago. So this chart, what this is illustrating is if you looked at just the cash account, the cash percentage, if you had invested over the last 10 years, just kept your money in cash, slept well at night, you never had volatility, you kept your money in the bank, your money would grow roughly just over 1% per year. Okay. Now, the CPI, the inflation rate over that same period of time was roughly 3% per year. Okay. So if you just had money just sitting in cash, you were losing 2%, roughly 1.5% to 2% every year by doing nothing. Okay. Well, if you invested the money, whether it was in bonds or stocks or a combination or what have you, real estate, you would have to go through these periods of contraction. Okay. 2016, COVID in 2020, the bear market here in 2022. While despite the volatility, and it makes us feel a little anxious as investors, folks, you still have more money than what CPI is. So even when we go back to our planning that we do with a lot of the families, and we forecast out, we always forecast a conservative number. And when we look back at where we're at in terms of forecasting, most of our families, if not all of them, are actually still on track and ahead, despite COVID 2020 and the most recent bear market. So folks are doing the right thing with their money, but the challenge is for us to actually outpace inflation. We have to go through some of these periods of uncomfortable markets that will pass over time. Okay. We have to remember there's good markets. Okay. And then there's periods of negative markets, but the good markets, the positive markets, largely outweigh those negative periods. Okay. Now, not only is it important to understand that of why we invest, but it's also important to understand the taxation. Okay. I added this slide because I've been getting a lot of questions about GICs specifically. And so what I did is I took a GIC, okay, and I showed the BC rate, and I'm going to show the highest rate, and I'm going to actually make some other comments afterwards. But if you're in a tax bracket of 53.5%, which is on the high side, for a lot of retirees, you're probably in that 30 to 40% tax bracket, the top tax bracket, not the average blended, but the top marginal bracket. So in this case, if you were to receive interest income, so you invest in a GIC or a bond, it pays you interest. If you're in a 53.5% tax bracket, you pay $5,350 to the government, and you're left over with $4,650 after tax. Okay. Now you might say to me, Wes, I'm not in a 53.5. That's fine. Let's say you're in a 30% tax bracket. Well, you still pay $3,000 on $10,000 of interest income, and you'd be left over with $7,000. The tax is still the same. The proportional or the ratio is exact same. All right. Now, using the same example at the 53.5%, if you actually get capital gains, let's talk about that first. Capital gains are only taxed at half the rate, so 26.75. So again, if you have an investment that goes up by $10,000, you only pay tax on the $5,000 realized gain. Okay. Now, of that $10,000, you pay the tax to the government, you're left over with $7,325. So when we actually look at the difference between interest income and capital gains, the way it's taxed, you're actually left with almost, 60 to 70% more money on capital gains after tax than when you are with interest income. Okay. Now, if it's invested in a TFSA or an RSP, there's no tax as you earn the money. But in an RSP, keep in mind, when you take it out, you're taxed similar to interest income. The full amount of the withdrawal is taxed at whatever your marginal tax rate is. Okay. Now, eligible dividends, I kept that to the end. Eligible dividends fall in between interest income and capital gains. Okay. So you're only taxed 36.54. So therefore, you make $10,000, you're left over with $6,346. Okay. So when you actually look at the net return of what you're putting in your pocket, not only do you want to look at what you're investing in, but what account it's in and what kind of tax you're paying. And again, if you said to me, Wes, I'm only in the 30, 35, 40%, it doesn't matter. The actual breakdown in terms of tax efficiency is identical to these numbers. Again, your tax rate is just lower. So it's extremely important to understand that. So with GICs, and I've actually had a couple of questions come in here about GICs, so I'll make some comments about it afterwards. But again, interest income, and especially if you're a business owner, you have a corporation, interest income is actually a tax. Everything's taxed at 50%. It's passive income, but interest income is the worst. Okay. All right. So I'm going to switch gears. I'm going to talk a little bit about pension style strategies. And for a lot of you, this is a recap. I think it's important to go back and just remind ourselves that we aren't traditionally or not following just everybody and just doing the exact same thing, which is traditional investments. We've introduced a number of different asset classes for the folks that are on this call. We've done real estate. We've done real estate in the U.S. For those of you that do own the U.S. apartment, I'll tell you, I heard it came across my desk. I understand that the last property that was in there has recently sold. So everything should get wrapped up by the end of the year is the goal, if not early next year. But we're hoping to get it done and distribute everything. So this would be the final tax return. The return on that has been exceptional. Again, as opposed to having money in just fixed income or bonds, what we did is we introduced a real estate investment that was taxed better than interest income, and it provided a regular predictable income each year. Plus, when they actually sold the properties, there was capital appreciation. So there's an example of doing something in a non-traditional manner, but that one was just a one-off investment that we did about 5 years ago. Okay, so let's look at Canadian pension plans. So the world top 20 pensions. So what are they doing? So when you actually look at the top 20, what's interesting is number 7 here is the CPP, Canadian Pension Plan. Number 17 is the Ontario Teacher Pension Plan. So what's interesting is Canada has 2 of the top 20 pension plans in the world. And for most of you, almost everybody on this call, you're either contributing to the CPP or you're getting money from the CPP. Okay, so let's unpack to see what they've done over the long run. And by the way, folks, this is an institutional type investment strategy, right? It's a pension plan, but this is the CPP. But if you were to look at the UBC pension plan, teachers pension plan, U.S. endowment plans, charitable foundations, a lot of them are doing something similar with the asset classes. And what they found is the more non-public, non-traditional asset classes they add to their allocation, their mix, their risk goes down and their return goes up. Okay. So when you look at, when I say different or alternative asset classes, I've highlighted these here in the green. So private equity, real estate, infrastructure, private debt, private real estate. Okay. So, CPP about probably 15, 20 years ago recognized that there was going to be more people drawing on the plan than contributing. And what they recognized is they said, hey, we need to get consistent and predictable returns that gives us a reasonable chance to actually earn a good rate of return so we can actually maintain the liquidity and viability of this actual pension plan. So when we look in 2005, only 4.3% of their investment mandate was invested in these asset classes, these alternative asset classes. Okay. Well, if you fast forward to 2018, over 50% of their underlying portfolio strategy was allocated to these asset classes. Now, you might say, Wes, this is 2018, it's 5 years. And you'd be fair to say that. So if we fast forward to 2022, this is from their report, what's interesting is public equities and public fixed income represent roughly a third. So they've actually increased from 50% to over 60% in alternative asset classes, infrastructure, real estate, credit, private equities, private real estate, and so on. Okay. And so there's this shift. But even though, the CPP and all these big pension plans, they've done this, and you would think, hey, positive returns year in and year out, just to let you know, every one of those pension plans last year posted a negative return in that 1 year. Okay. But they're actually going to be on track again this year as markets stabilize. But again, they outperform the broad market. But again, even these institutional money managers, they go through ebb and flows as well. Okay. So when we look at this pension style or the CPP, like I said, 2/3 of the CPP is allocated. But what's interesting is retail investors like you and I, less than 1% of retail portfolios have alternative investments included in it. Okay. They have those traditional asset classes like fixed income, like publicly traded REITs, which I'll show you in one sec. And so Canadians are subject to these massive declines over the last 3 years, given what's been happening with interest rates. Okay. So let's just talk about real estate for just one quick second. Okay. Now, most often Canadians, they get real estate included in their portfolio by adding a publicly traded REIT. Okay. So, and I'll talk about one in a second. But again, a publicly traded REIT tends to have really good income, but it trades on the open market, the TSX, the S&P 500, or what have you. And therefore, the market price goes up and down depending on what's happening in the economy. Okay. So when we look at just, a real estate in general, if you look at the right-hand side of the graph here, or the chart, and again, this goes over a 30-year period. If you look at the right-hand side, these are equity markets. Okay. Some people might have seen this already, but equity markets in general average roughly double-digit returns. Okay. Canadian, US, global, emerging markets, and so on. But in order to generate that average rate of return of 10%, there were some years that were really good, and there were other years that were really bad. Okay. So what's interesting is the volatility that investors had to suffer was actually on the high and the low. Okay. Now, when you look at real estate sectors, commercial, industrial, office properties, retail, and then multifamily or income generating, you can see they generated somewhat of a similar return, but the volatility was much less. The worst drawdown over that 30 years was 11%, which was office properties. Okay. When you look at the most stable, the most predictable, it's this income generating, this multifamily income generating property. Okay. Ones that are actually paying rent. Okay. So as an example, with all the immigration I mentioned before, because we have this big demand on real estate, on rental properties, the rental prices continue to go up. Okay. There's such a demand for it. And we have more people coming into the country than we actually have units that are being built on an annual basis. Okay. Now, I actually just read an article about 3 weeks ago in New York. Granted, it's to the US, I get it. But the average rental cost per month for a property in New York is over $5,500. Okay, which is astronomical. But if you ask around friends or family that have rental properties, depending on what kind of rental property, it's probably between $2,500 to $4,000, if not more, if it's a full house. It is extremely high right now. So you and I, we could all go out and buy property, but the problem right now is interest rates are high and the banks require a significant down payment. Plus, they're also not lending. So how do you get access into some of these kind of real estate investments? Okay, so before I get into what our clients are doing, here's an example of what a lot of Canadians do. So this here is RioCan. This is a publicly traded company on the TSX. Okay, this is a 3-year return, which includes COVID. Now, RioCan, for those of you that are familiar with Langley, I'm going to talk about Langley because they have 2 properties out there. On the Langley bypass, there's a property where Cactus Club is. So if you don't know Langley, but you know where Cactus Club is, that property, that development where Cactus Club, Golf Town, and so on, the locations are, that is a RioCan property. Okay. Now I live out in Langley. A lot of you know that. When COVID hit in 2020, I've never seen Cactus as busy as it's been with takeout orders and so on. Golf Town had some of their best years because everybody was playing golf. And when you looked around, there wasn't very many vacancies. Most of the companies that were renting from RioCan, they were still there. They were getting government support and so on. And I'm pretty sure, because that's a prime piece of real estate, I know my house went up in 2020, 2021, and so on. I'm pretty sure the value of that property went up. Okay. But when we look at their price in 2020, it actually fell almost 55%. Look at that, from there to there. And then it took close to almost 2.5 years to get back to where it was in pre-2020. And then as the Bank of Canada started to increase rates, look what it's done. It's gone back down because these are interest rate sensitive. So RioCan, including all their distributions over the last 3 years, has actually posted a negative 17% return. Okay. Now you might say, Wes, you're talking about one REIT. Okay, so if you actually look at just the CAP REIT index, it's an ETF that tracks a basket of REITs. You're absolutely right. The RioCan posted a worse number, but if you look at just the general index of REITs, down almost 11%. Okay. Now, again, there are portfolios we see come across our desk that have a whole bunch of REITs. All right. Now, if we come across REITs that clients are owning or individuals are owning, we likely won't just sell it right out. We'll actually reassess it and say, hey, what's the income? What's the upside, and so on and so forth. Okay. But given the fact that the interest rates could be at this level for a little while, if not go up a bit, we're not looking at a lot of publicly traded REITs. Rather, our clients have been investing in private REITs through the Foresight private real estate portfolio. Folks, in 2020, in March, where we saw this significant drawdown on the public markets, Foresight was down 0.15%, and it posted a return just under 12% that year. Okay. It's been positive every year hereafter. And over the period of time, I think it's done between 20 to 30% over this 3-year period. So super strong. Again, a lot of it is income generating properties, student housing, apartments, commercial, and so on. And again, it's been very consistent and predictable. And again, as opposed to using traditional, real estate or fixed income, we've been able to have a sleeve or a slice of that one investment within the portfolio to minimize some of the risk for our clients. Okay. Now, again, if we look at private credit, again, this is just another one. This is just a couple of different bond investments. Okay. There's the Canadian Universe bond. There's a total bond market. So we've actually just tracked a number of different ones to give you an idea that it's just not one investment that's done poorly, but rather a number. And these ones are total returns over the 3 years. But again, if you would have owned fixed income, you would have been down roughly 15% on average. Okay. Our clients, again, have access to a private credit investment that's yielded roughly 6 to 7% on an annualized basis. So again, instead of, running and doing what everybody else is doing from a traditional standpoint, we've been able to bring some creative solutions to the retail public, including the folks on this call, and get consistent and predictable income without the same volatility as some of these other asset classes. Okay. All right. So switching gears. So again, I said I would talk for about 45 minutes or so. I'm coming up to it. I have about 5 to 6 slides left, I believe. So we'll just talk about this. This is just a recap, folks. Great session. Very well received. So just a couple of ones that didn't attend. I really want to drive this home. So again, a couple of points, just wealth transfer by the numbers. When we look at it, Canadians are entering an age of unprecedented wealth transfer. There's going to be a significant amount of assets that are going to pass from our generation to our kids. Okay. And factors that will significantly impact the numbers to even a greater extent of where they are today. Obviously, economic growth, stock markets, real estate prices. Right now we're in a little bit of a lull, but there's still a lot of activity that's happening. Okay. And if you're a business owner, this isn't a wealth transfer in terms of an estate wealth transfer. This is a wealth transfer just simply of you moving your business to somebody else, whether it's your kids, whether you're selling it. But 70% of private company owners plan to sell or pass on their business in the foreseeable future. Okay. So if we look at it from a generational point of view, there was a Merrill Lynch survey. Again, 57% of respondents aged 55 and older said leaving an inheritance was the right thing to do. Okay. And when we look at millennials, 55% said it's our obligation to leave an inheritance. So again, what I'm finding is a lot of our families are going to have assets to pass along, but you don't want to actually impact your retirement because you're actually gifting money to the kids. So you want to have a good balance. Okay. And the last one is, again, that most millennial parents, which is the baby boomers, they partially agree that 36% felt that an inheritance is a parent's obligation too. So there is somewhat of a connect there, but it's not exactly the same. So again, financial literacy amongst our kids, it's a big one. Get out there and teach them a value of $1 because again, they're going to be inheriting a lot of money. So just really quickly, according to 54%, this is gifting. More than 1 out of 2 individuals say they plan to give during their lifetime to their kids. And this is a conversation we're having a lot with folks. Just a couple of things, be generous to yourself first. Again, you don't want to significantly impact your retirement or your post-working lives based on giving money away to the kids. Pick the right pace. You don't have to give all at once. You can give over time, I think, which is important too. Don't forget about the tax. There's no taxes when you gift to the kids. Okay. But there could be tax consequences when you raise the money. When you draw it out of an account, you might be on the hook with some taxation. Okay. And then I think important, make a plan. So again, having a solid financial, like a long-term financial plan that takes into account future income, cash flow, travel, health concerns is really important to give you an idea of what kind of pace can you give or can you give it all. All right. So last 2 slides, I think this is interesting. So, if you look at Canadians, 91% think wills are an important component of an estate plan. I think they are. We talk about it all the time. 86% thinks appointing a power of attorney is important. Again, it's right up there. And over 77% think it's important to talk about their healthcare wishes with either their family or their healthcare providers. And this is a big one. We're talking about this a lot more. A lot of folks might have a will. They may have a power of attorney, but having a representation agreement or health directives is very, very low. Okay, so this is something that we're just educating folks on right now. So this is the perception. This is what Canadians think. Well, what's the reality? Look at this. So number one, 70% of Canadians do not have a financial plan or an estate plan. Okay, so it's really difficult to plan when you don't have a plan to figure out what your taxation is. Less than 48% of Canadians have a will. So remember that number before. Over 90 said it was important. Less than 48 have it. Okay. Power of attorneys, less than 65% have one. So again, almost 90% said it's important, but only 65% or less than 65 have it in place. Okay. And look at this, healthcare directives. Only 7% of Canadians have either spoken to their family or their healthcare providers. So this is something, again, and I often say it's never important. It's not important until it's important. So folks, if this is something that's on your mind, let's have this conversation. Then it's help get you pointed in the right direction. We will remind you time and time again that these are important things to get in order. But what I generally find is folks will come to us when all of a sudden they have a change in their health condition, or maybe a loved one or a family member, maybe they've had a health change, and now they recognize the importance of taking care of their families and getting things in order. Mm-hmm. Oh, and by the way, folks, on this one here, on the wrong execution and the legacy, we did send out a replay of the session. If for whatever reason you didn't see it, just give us an email, send us an email, give us a call. We can always re-forward it to you. Okay. So 9 most common planning mistakes. I'm going to rattle them off pretty quickly here to stay on time. So number 1, not having a will or an estate plan, extremely important. Number 2, having an out-of-date will. So I come across a lot of folks where they might have a will 10, 15, 20 years ago. Maybe they have grandkids. Their kids are, no longer minors. So again, you want to make sure to update it and that your wishes are well documented. You don't want to leave it up to a court. Number 3, not being specific enough. So making general statements. Again, you might just say, "Oh, I want it to go to my kids." Well, that's fine. But if the situation has changed, maybe you want it to go to the kids in trust, or maybe you want to have the kids access that money, in a specific way. So maybe you need to set up a trust to give some direction and so on. Failing to consider tax implications. This is a big one. So some people might, gift or give an RSP to one person and a non-registered account to someone else. Well, an RSP or a registered account is taxed at a much higher rate than a personal account. You don't consider health or incapacity planning. We talked about that. Forgetting to leave an inventory. So what I mean by this is a lot of folks might put a will and a power of attorney in place, but they don't actually leave an inventory. So their executor or their family, when something happens to them, they're left scrambling around trying to figure out how that individual wants their inventory or their assets to be broken down. And I think one of the biggest ones that we see isn't so much the big ones, the house, the accounts, and so on, but it's those keepsakes. So those keepsakes that have family memories that maybe one individual wants more than the other. And this is where we can actually see some family disharmony. So again, leaving some of the wishes on that inventory is really important. Not thinking about beneficiaries. Again, if you happen to have, grandkids or what have you that have since come along. If you're in a blended marriage now, maybe you're married for a second time with other kids, you want to give that some thought. And the last one is just not seeking professional advice. So a lot of folks, not necessarily on this call, but they'll opt to try and save a few bucks, do it on their own. In a very simplistic situation, maybe that's okay. But for most of the folks that are on this call, you want to be talking to a professional, the trust, the power of attorney, the health directives. You want to be talking to a lawyer because trust can't be done with notaries. Okay. And then last one, estate plans to help tax efficiency, family harmony. I just mentioned that. Speed. So again, right now, when somebody passes away, it takes a while for them to settle the estate, unfortunately. It's really slow post-COVID, but having things in order helps. Gives you control and confidence of how your wealth will be distributed, and then peace of mind. Peace of mind, I think, is a big one. All right. So here's the last one. Like I said, I've been chatting now for about 40 minutes, give or take. So we're going to actually finish up on the 6 year-end tax planning tips. Number 1, we will do this on behalf of most of our clients that are here. In your non-registered accounts, we will look at doing tax loss harvesting or tax loss selling. The reason why it's relevant today is if you actually trigger a loss on paper, simply on paper. So you have TD Bank that's down $5,000. Well, if we just simply move it to Royal Bank, so you're still in the financial sector, but by selling TD Bank, you have the same value in TD Bank as you do Royal, if we think Royal is a viable investment, but you've triggered that $5,000 capital paper loss. Well, the benefit of that is you can carry it backward 3 years and you can carry it forward forever. So folks that maybe have, properties, investment properties, second properties, or what have you, getting some of these paper losses on the books is a good thing. So because we're coming out of 2022 and to a certain extent 2023, we will review the accounts and trigger where it makes sense. Okay. Number 2, should you make a registered plan withdrawal? So in some cases where you have one spouse, or maybe you're an individual, and you might, for whatever reason, have low income, we could look at actually taking out a withdrawal from a registered plan, specifically an RSP, a LIRA, what have you. Maybe taking a withdrawal out because, again, if you have low income, you're going to get taxed at a lower rate than likely where you are in the future. Okay, and we are doing some of these, having some of these conversations between now and the end of the year. Okay, income splitting. For business owners, are you income splitting with other shareholders, with a partner or a spouse or what have you, maybe kids if they're a shareholder? Are you paying out reasonable income to them? Okay, maybe there's some, maybe we have one individual that's maybe doing some bookkeeping for you. Are you paying them some income to actually do your bookkeeping? Number 4, this is a little odd, but triggering capital gains. So triggering capital gains, again, 50% taxable. In a corporation, it builds your CDA, your capital dividend account. So it actually creates money that can be withdrawn on a tax-free basis. But also, if you happen to be in a situation where maybe you're going to have higher income in the future years, you might want to be triggering capital gains now. Or maybe if you have capital gains and you want to trigger them next year or what have you, maybe it's triggering it over 2 years, a little bit this year and a little bit next year. Okay. Contribute to a registered disability plan, an RDSP. So you have to the end of the year to do this if you happen to qualify for one or you have kids or grandkids that qualify for them. So an RDSP. And then the last one is charitable donations. So in kind or otherwise, if you were trying to save some taxes, looking at maybe if a charitable donation, that tax credit will actually help you out. But again, we have till the end of the year. You can donate in kind stocks out of a non-registered account. If that helps, you actually defer the tax and get the tax credit. Okay. So with that, that's my last slide, folks. Now I'm going to open up for Q&A. I'm going to have a look on the right here, just on any Q&As that we might have had. In the meantime, feel free to type any questions that you do have. And I do have a couple, so let me just have a look. Yeah, you know what? I briefly touched on this, but the question was, any comments on the impact of the Israeli and Palestine war? Markets don't like uncertainty. We saw this with Russia and Ukraine when this started, which seems like a lifetime ago, but it's ongoing. But I think anytime there's a little uncertainty, we have to be mindful of the markets. Again, much like the comments I made with the Russia-Ukraine situation, I think the same applies here a little bit. I think it's a little bit more of a, again, not to give my own political views or what have you, but it seems like a little bit more of a volatile situation than maybe what we saw from the previous situation with Russia and Ukraine. But that being said, I think our portfolios are well positioned from an economic point of view. I think that's more what's telling to me is what's going on with the central banks. And that might be even one reason why central banks might look at, their policy and might say, as much as we might want to increase rates, we recognize that the markets right now are a little bit on some unstable grounds. And when I say unstable, just given what's happened geopolitically, and therefore they might be a little bit mindful. They definitely take it into consideration, but at the end of the day, they need to get those inflation and labor markets in line. So I think any unrest is never great for the markets, but we really haven't seen a lot of negativity here in the short term since the outbreak started. So, okay, I actually have another one. So another one was said, GICs and thoughts. I actually commented a little bit about this earlier. Folks, a GIC today, a 1-year GIC, you can get probably better than 5.6 to 6% right now. We're not actively putting in 1-year GICs right now, unless it's situational, unless it makes sense for the individual. Just because, again, we're trying to keep it a little bit more liquid. The rates are getting to the point where we are considering them on a little bit more regular basis instead of maybe some fixed income. We're hanging tight to see what the Bank of Canada does in the next in the short term here with their policy. If they do increase, obviously GIC rates will get a little bit more attractive, but so will the cashable rate. So right now we have a fully cashable investment that pays just better than 5% right now, which is solid. If you actually look at 90-day GICs or 30 or 60-day GICs, they're not as strong as this one. So it's a massive investment. I think it's 4 or 5 billion, even more now. And it's the underlying investments are a lot of just bank a short-term investment product. So the companies are able to buy them at significant discounts because, again, the volume. And as investors like us, we can actually tap into it. So I think, again, a GIC does make sense for some people, depending on your tax situation, depending on your cash flow. But if it's not that, then a cashable security, I think, is ideal as well. Okay. Now I have someone else that says, what should I do if I have extra cash, which is a good question. So again, if you have extra cash, what I would do is, again, chat with us, but I would reevaluate any debt you have. So if you have variable rate debt, if your variable rate debt right now is at 7, 8, 9%, paying that down in the short term, the benefit is that you're getting a 7 to 8 to 9% return on that right now. Okay. It's the equivalent of getting that in the short term. What I would say, if you're paying it off, I would really hope that you have the ability to reborrow it, because again, if things change in the market and we get the wind at our backs as the central banks, again, change their monetary policy, having access to it, I think, is a good thing. But yeah, I would look at actually looking at paying down debt. The second thing I'll look at is maybe deferring tax. So should you make an RSP contribution? Okay. Should you actually get that tax refund next year? It's not such a bad thing at this time of year to be doing it, because the gap between making the contribution and getting the refund is only a few months. Okay. Then the third one is I would get it working. A lot of people will just leave it in the bank just out of, being lazy. And again, I'm not saying folks are lazy. It's just we're busy with life, and to actually get it working, it's kind of out of sight, out of mind. So what I would do is I would just invest it, in a cashable GIC or cashable investment I mentioned that gets you roughly 5%. So now you're actually getting some money earning on it. And the banks won't be happy with you, because when you have money just sitting in a bank account, you're one of their favorite clients, because they give you a couple percent and then they go lend it out at 7, 8, 9%. So you're the perfect candidate. So what I would do is, again, get it working. Okay, why don't you collect the 5% versus the bank collecting the 5, 6, 7%? Okay. I have another question here. Hang on tight here. Should be invested in private real estate. I have a good comment. So it says, what percentage of your portfolio should be invested in private real estate? It's a very good question. So as much as I think private real estate is an excellent asset class, I'm just mindful of being overly concentrated in any specific asset class in general. So I think if you have anywhere between 10 to 15%, depending on what your long-term or even medium-term risk objectives and what you're hoping to accomplish, you can have a higher percentage. But again, it depends on what kind of cash flow you have outside of that portfolio. The private investments, the alternative investments, in this case, Forsyth, I'll talk about that one specifically. That one trades on a monthly basis. Okay, it trades at the end of every month and then takes about 3 weeks to settle thereafter. So if there's an individual that says, yeah, I want more in it, we just have to be mindful that the liquidity is still reasonable in your situation. Okay. Now, Forsyth, one of the benefits and the private credit pool is they are a multi-manager, multi-strategy investment. So what I mean by that is I think in Forsyth right now, there's more than 15 sub-advisors. There might even be close to 20. So the benefit is that by investing in one investment, you really get access to 15 plus investments. And on the private credit pool, it's the same thing. Okay. So again, it is situational. I know what you're saying. You're saying, hey, if the returns are so strong and the risks are lower, should I invest my whole portfolio in it? I'm just not a fan of just being really concentrated. I still think there's a benefit of some publicly traded equities, especially given where the markets are today. So, okay. So I had somebody else that said, curious about reno evictions. So what she means by that is saying, hey, a bad practice of raising rents and then pricing people out of the market. So a lot of these investments that are held within this private real estate portfolio, they're not in the business of actually doing renos. Okay, we did an investment 4 years ago where companies went in, they bought properties and they did reno, but they didn't increase the rent severely. It was very nominal because they added value. They added washers, dryers, kitchens. So that's not something that would be in the Forsyth private real estate portfolio. Generally, what it is with those ones is their existing buildings. These companies, they want to own the buildings. They buy them for income, and they allow investors to share in that income. So they're not going in and renovating and so on. The majority of them, they're just simply owning the building and managing the rent. Okay. Now, when people do move out, they have the right to increase that rate. But as you know, there's restrictions on how much you can actually raise rents, especially folks here in BC. So it is a balance. But again, I think the ones that we have in there, student housing, it tends to be a cyclical type process where you have students that are coming and going over a 1, 2, 3, 4 year period. So again, no rent evictions, but rather just, again, it's just the nature of the strategy. Okay, same thing, storage housing or storage units. Okay, there's storage in there too. So again, that's not something when you're renovating and evicting people, but rather it's just an asset class that is very strong from a cash flow perspective. So very good question. Very good question. Okay. And I got here's one more here, guys. Yeah, this is a good question too. So they said, is there a risk of Chinese real estate collapse will spill into North America? I guess it's possible. It's possible that, if there happens to be pension plans or what have you that have invested in Chinese real estate. That being said, I think, in general, we have lots of great real estate here in North America, both the US and Canada. I can speak to, from our when I say ours, the private real estate pool that our clients invest in, most of it is all in North America. Okay. But, China is one of the biggest economies of the world. So I would anticipate a little bit of contagion. To what degree, I'm not sure. But it just wouldn't surprise me. But I don't think it's a significant one. We've already seen adjustments to some of these really big property companies in China. Some have gone bankrupt. Some have written down some of their properties. Some have done cash calls. But we haven't actually seen any effect of that in North American markets. And again, it's not something that's just happened today. This has been an ongoing trend out of China. So again, I think we're in pretty good shape, to be honest. But I just never want to say never. Again, we need to be mindful, make sure we understand the investments our clients are owning, and take a again, back to the question that I had earlier about putting the majority of the money in real estate or private credit. Again, this is the reason we go back and we diversify. So if there is a little bit of contagion, it happens on a very small basis. Okay. And that could happen even if you buy an index fund of the market, in the S&P 500, there's 500 companies there. It's likely probable that there are some companies, whether it's the banks or what have you, that have some exposure there. But again, if you buy a broad-based investment, you minimize that risk by taking, a pragmatic approach. Okay. Folks, that was my last question. Okay. So, thanks again. I really appreciate you hanging in there and spending, this Wednesday afternoon, like I said, a miserable Wednesday afternoon. So like I said, if you have questions, you have comments or what have you, feel free to reach out. You have my email, you have my address, or my email address, my phone number. Feel free to reach out and we're happy to provide some comments. Once again, this will be the last session for the year. If there are any sessions, and I should have asked midway because I see some people jumping off, but if there are any sessions that you would like to see. So I asked last time, I said, hey, listen, would you like to see a special estate session where we talk about legacy planning? And we had an overwhelming response of people putting their hand up saying, yes, I would really like one. So if there's something specific that you would like something on a one-off basis rather than a quarterly update or an economic update, maybe it's on planning, maybe it's on taxation. I'm not quite sure. But please send it in the Q&A or send us an email. We generally do a survey as part of the email that we actually send out. You're more than welcome to add it there. We do look at them. I'd be more than happy to do any one-off sessions that you feel would be useful in your situation. If we get enough feedback, we will hold a dedicated session, and we could even do one prior to the end of the year. I don't want to get too late in the year because of the holidays. But again, we could probably do something in mid-November or what have you. So again, once again, thanks everybody. I really appreciate it. Give that some thought and have a great October. Have a good Halloween. And like I said, if you need anything, please don't hesitate to reach out. So thank you. Have a great day.